Walgreens reported fiscal first quarter earnings and revenue today, beating street estimates. Despite the ongoing store closures and other cost-cutting measures, those likely helped a little bit. Earnings per share came in at 51 cents adjusted versus 37 cents expected, and revenue at $39 billion versus $37 billion expected. To dive into some of these numbers and for more on the prospects for Walgreens, we're joined by Elizabeth Anderson, Senior Managing Director at Evercore ISI. Hi, Elizabeth. Thanks for being with us.
Hi, good morning. Thanks for having me.
All right. So they beat estimates, although there was a net loss. And is this primarily because of cost cutting? We know they're looking to cut or close 1,200 stores over the next 3 years.
Yeah, so I think we had a couple of different factors going in. Remember, the new CEO has been there for about a year, so he's had a little bit of time to start putting through some of the ideas that he wants to improve the profitability of the business. So we had some of the store closures. Now, Walgreens has said that they don't close a lot of stores before the holidays, and this is reported. They're reporting their quarter that ended on November 30th. So only closed 63 stores off of the total, which is fewer than many had expected. But you had those store closures certainly helped. They talked about procurement savings, right, for across the board in terms of both front end and a little bit on the drug side. And then they also talked about higher COVID vaccine reimbursement versus what they had gotten historically. So there were a couple different factors. Also talked a little bit about improvements in their European business. So there are a bunch of different places where we started to see improvements in profits this year.
Overhanging all of this is the fact that we know the company's in talks to possibly be bought by Sycamore Partners. So why are they doing this? Why would they go private?
That's a great question. Turnaround, obviously the ultimate reason will be in their decisions. And we didn't hear any incremental information updates on that potential transaction today. Often turnaround, Walgreens is still in the midst of a turnaround, right? They have a lot of work to do to get the profitability back to, I think, where they would like it and where investors would like it to be. Obviously, turnarounds are easier to do outside of the public eye. So, that would be sort of my speculation in terms of that. But we'll ultimately see what happens on that, but no update today on that front, which might have surprised some people, but that's what we have. That's what we have so far, and they were not commenting about that today on their call.
Okay, Elizabeth. So the CEO has said this turnaround will take some time. Let's assume they stay public. Do you believe they can make this happen?
Yeah, I mean they had some incremental good data points on this front. So not reflected in this quarter's results. They talked about how they're starting to achieve better results on pharmacy reimbursement. This has been the key thing that has driven the profitability problems at Walgreens, that they are seeing less and less reimbursement for the scripts that are going through their stores. So they, as well as their competitor CVS, put out a press release on Monday saying very much sort of the same thing. So we should start to see some profitability improvement on this. The question will be, is that enough? I think that still remains an open question for both businesses, but it was nice to get confirmation from both of the major chains in the U.S. that this is something that is actually going through and that payers are agreeing to do it.
I see that international sales seemed to be growing decently. This Boots Alliance arrangement that they struck quite a few years ago now, has that ultimately worked, that takeover of Boots Alliance?
I think it's probably turned out a little bit different than they had initially suspected, right? I think some of the initial expectations were to sort of bring a bunch of the Boots brands into the U.S., and that sort of didn't go maybe as originally expected. But the Boots business has a very strong position in the U.K. in terms of the pharmacy market. They have undergone their own challenges in that market with NHS reimbursement, et cetera. But the Boots has a very strong position. They've gained some market share. Some of their competitors have actually struggled more. And we saw very nice results from the investments they made in the Boots online sales division. There's also a small German business in that too, which continues to do quite well as well. So overall, I would say that's probably a relative bright spot in terms of the overall earnings growth story going forward.
Would you say that some of the gains we're seeing on the stock today may primarily be because of short covering? Because I think the number was about 13% heading into the earnings.
Yes, I think so. I think we had a position where people were worried that pharmacy reimbursement would take another step down. We had reports that the cold, cough, flu season, at least until the end of December, was actually quite weak compared to last year, which impacts not only prescriptions that Walgreens fills in the back of the store, but also people who buy cold, cough, and flu medication in the front of the store to control their symptoms. So that they did call out as something that impacted, but it wasn't necessarily to that same extent that I think some investors had been expecting.
And just overall, I'm looking at a long-term chart right now of Walgreens going back many years. They had such a great run in the 90s and into the 2000s, but the stock peaked in 2015 and it's kind of been downhill ever since then. So can you just sort of give us the overarching reasons as to why they've wound up in this position?
Yeah, absolutely. So I think over that period of time that you highlighted, obviously in the 90s, they had a nice growth. They were expanding stores. We saw a lot of different new services that they were offering. And then as we got into the 2000s, particularly into the 2010s and forward, we did start to see a lot of pharmacy reimbursement headwinds across the U.S. This is something that's not only impacted Walgreens, but it has impacted CVS. Rite Aid actually went bankrupt and has since emerged from bankruptcy. But pharmacy reimbursement has gone down over 50 basis points or 0.5% every year over that time. And if you're a business that loses 50 basis points of gross margin, that's very tough to offset over time. So that's part of it on the pharmacy side. I think also on the front end of the store, so we're thinking about health and wellness products, beauty products, personal care products, toothpaste, that kind of thing. That's something that was hit by internet sales relatively late. I think consumers were comfortable buying books and CDs on the internet well ahead of when they were confident enough to buy toothpaste and other personal care products on the internet. And so because of that, we saw the impact of online retailers start to hit those stores like Walgreens and CVS and others much later. So that's another thing that I think has helped to drive some of the profit troubles that Walgreens has seen over that time. But largely, I think the biggest impact is the pharmacy reimbursement headwinds. That's why today's announcement and CVS's announcement on Monday that some of these pricing pressures could ebb in 2025 and 2026 is pretty important.
All right.